Right now, in the exact same country, we're seeing two completely contradictory economic realities playing out at the exact same time.
Yeah, it's honestly wild to look at the data. It is the absolute definition of a structural contradiction.
Right. Like on one hand, you have a woman in a remote, completely off-grid rural village.
Right, someone with zero formal credit history.
Exactly. Zero history. And she's on a smartphone securing this AI-generated nano loan in milliseconds.
Yeah.
I mean, that is literally rewriting global poverty metrics.
It is. It's revolutionary success at the very bottom of the socioeconomic pyramid.
But then, just a few miles away in some metropolitan high-rise, the country's top-tier banking institutions are bleeding out.
Yeah, bleeding out from a catastrophic 6.44 trillion taka black hole of willful debt.
Which is just an insane number to even wrap your head around. So,
Right.
welcome to this deep dive. Today, we are going to look under the hood of these two totally diverging realities.
Yeah, we really need to take the incredibly complex machinery of global finance and use the rapidly evolving financial sector of Bangladesh as our ultimate case study here.
Right, because we want to understand how these systems actually govern our world. For you listening, if you've ever wondered how a seemingly robust economic engine can be, like hyper-innovative but dangerously fragile at the same time, this is for you.
Because the data we are pulling from today's sources just lays it all bare. The Bangladeshi financial sector is basically the perfect microcosm.
It really is. It forces us to examine the actual nuts and bolts of how capital moves, how trust is quantified.
And what happens when the fundamental rules of banking are either democratized for the masses or, well, manipulated by the elite?
Right. So before we get to the massive inclusion revolution or that trillion taka debt crisis we mentioned, I feel like we need to... Exactly. Because the sources heavily reference this dynamic between commercial banks and the central bank. And I think for anyone building out their own mental models of macroeconomics, we really need a dead simple breakdown of the players.
Right. It's crucial to separate these two entities because their underlying incentives are entirely different. They're completely distinct beasts.
So commercial banks are the ones we see every day, right?
Yeah, the institutions with the branches on the street, the mobile apps, the ATMs, they are fundamentally profit-driven enterprises.
Okay, so their whole architecture is designed to interface with individuals and businesses to make money.
Exactly. But the central bank, which in this context is Bangladesh Bank, operates on an entirely different plane. You cannot just walk into a central bank and open a checking account.
Hi, they have zero interest in competing for retail deposits.
None. Its mandate isn't profit. Its mandate is gravity.
Gravity. I like that. So I was thinking about this analogy. Tell me if this works. If we think about the entire economy as this massive, complex hydraulic network pumping fluid around a city.
Oh, that's a great way to visualize it.
Right. So the commercial banks are the network of pipes, the valves, the localized pumps, directing that fluid to homes and factories. And they charge a toll for moving that fluid.
Yes. And in that analogy, the central bank is the overarching pressure valve system and the master reservoir.
Exactly. It doesn't pump the fluid to make money. It just monitors the pressure across the entire grid.
Right, to ensure the pipes don't burst from overpressurization or, that a neighborhood doesn't run dry because the pressure drops too low.
So commercial banks are the players on the field trying to score points, and the central bank is the referee with the whistle.
Making sure nobody plays dirty and the stadium doesn't collapse, that captures the systemic risk perfectly.
Okay, awesome. So the central bank regulates the pressure stuff like liquidity, interest rates, capital reserves.
Yeah.
But those commercial pipes, they rely on a few very specific mechanisms to actually stay profitable, right?
Yeah, highly engineered mechanisms. And the most foundational of these, the one that actually dictates the flow of capital, is the interest spread.
Let's isolate that term, because the sources pinpoint this as the primary engine of the commercial banking model. Break down the spread for us.
Sure. So in simple terms, a bank brings in capital by offering depositors a modest return, say a 4% yield on your savings account.
Okay, so I give them my money, they give me 4%. That capital is the raw fluid in our hydraulic system.
Exactly. The bank then redirects that fluid. They lend it to a business looking to, say, build a new garment factory, but they charge that business a 10% interest rate for the loan.
Oh, okay, and that 6% differential right there in the middle, That is the spread.
You got it. That is the gross profit margin. That spread pays for the bank's operational costs, its staff, its digital infrastructure.
And it's shareholder dividends, obviously.
Right, of course. The bank is essentially acting as an aggressive mediator between surplus capital and productive capital.
But this is where the sources get really interesting because the system moves from simple mediation to outright economic acceleration through this mechanism called credit creation.
Yes. This is where the physics of the system get genuinely fascinating and often very misunderstood.
Yeah, I want to push back on this a bit. The source text explicitly states that banks don't just act as passive vaults moving cash around. They actively create credit flows. Are they just printing money in the basement?
No, they aren't printing physical paper currency. If they did that, you'd get hyperinflation instantly.
Right, that's what I thought. So how are they creating credit?
It's through fractional reserve banking. It is arguably the most powerful lever in modern capitalism. They multiply purchasing power. Let's track a single deposit to see how it happens.
Okay, let's walk through it. I have 100 taka. I deposit it in my commercial bank account.
All right, so the bank now holds your 100 taka, but the central bank, the referee, dictates that the commercial bank cannot lend out all 100 taka.
They impose a reserve requirement, right?
Correct. Let's say the central bank mandates a 10% reserve requirement to ensure there's always some liquidity in the system.
So the commercial bank has to lock 10 taka in the vault.
Yes. But they are legally authorized to lend out the remaining 90 taka. So they loan that 90 taka to a local farmer who desperately needs to purchase seeds before the monsoon season.
Okay, wait. The implication here is wild. If I look at my mobile banking app, my balance still reads 100 taka.
Right. You have 100 taka of perceived deployable purchasing power.
But the farmer is now standing in a market with 90 taka of actual physical purchasing power. So for my initial 100, the economy is now operating with 190 taka of active credit.
Exactly. The money supply has functionally expanded, and the velocity of that money is just beginning.
What do you mean it keeps going?
Oh, yeah. The farmer uses that 90 taka to buy seeds from an agricultural supplier. That supplier takes the 90 taka in revenue and deposits it into their own commercial bank account.
Oh, wow. Okay, I see where this is going.
Right. So that second bank takes the 90 taka, holds 9 taka in reserve, that's the 10%, and lends out 81 taka to a completely different business.
That is mind-blowing. The single initial deposit just cascades through the entire network, repeatedly funding new economic activity at every single step.
This multiplier effect is literally the lifeblood of scale. When you look at the raw data for a country like Bangladesh, the stakes of this credit creation are staggering.
Because agriculture is huge there. The forces say it contributes over 11.71% to the national GDP.
And it feeds a population of 170 million people. They rely heavily on these cascading loans.
Not to mention the industrial sector. The sources highlight the massive demand for working capital.
Right. Working capital is just the short-term loans required to cover daily operational expenses, payroll, raw materials, keeping factory lines moving.
And then there are term loans, right? Which are the massive multi-year credit lines used to build entirely new infrastructure.
Exactly. In just the fiscal year 2024 to 2025, the credit allocated just to this industrial sector surged to over 97,000 crore taka.
Wow. So if the commercial banks stop creating that credit, the entire industrial engine basically seizes up overnight.
It completely freezes, which gives us the perfect transition to the first major phenomenon we need to dissect today.
The inclusion revolution.
Right, because for decades, this highly efficient hydraulic system we just described, it was completely walled off from the vast majority of the population.
Yeah, the pipes only reach the affluent urban centers. If you were a rural laborer, you were operating entirely outside of this system.
You were dealing purely in physical cash until financial inclusion became a priority.
Let's define that, actually. What does financial inclusion really mean? The sources use it a lot, but I feel like it gets diluted in corporate jargon.
It does, but the World Bank has a very strict operational definition. It is the integration of every demographic, regardless of income, geography, or social standing, into the formal financial ecosystem.
So true inclusion isn't just having a piece of paper that says you have an account.
No, it means having access to savings, loans, and investment tools. It means transitioning a society away from hiding cash under a mattress, which, by the way, has zero economic velocity, and bringing that capital into the formal banking network where it can be protected, tracked, and multiplied.
And the scale at which Bangladesh has executed this transition It's historically unprecedented. I mean, the data explosion in the sources is staggering.
Numbers are incredible.
Right. Like as of March 2026, there were 238.6 million registered mobile financial services, or MFS accounts. And active users doubled from 29% in 2019 to 56% in 2024.
Just think about the sheer volume of capital moving through those digital channels now. It exceeds 4,500 crore BDT every single day.
We really have to pause and contextualize what 4,500 crore taka in daily digital volume actually represents for a developing economy.
Well, historically, roughly 80% of the Bangladeshi economy has operated in the informal sector.
80%. That means transactions were purely physical cash.
Exactly, leaving no paper trail, generating no credit history, and offering absolutely no security against theft or a natural disaster.
So shifting that immense volume of informal activity onto a secure digital ledger, that is a seismic shift.
It's a profound behavioral and infrastructural achievement. But, the logistical challenge of that shift is massive. You can't just snap your fingers and mandate financial inclusion.
Right, and you certainly can't build a traditional marble-floored bank branch in every single remote village.
The overhead cost would bankrupt the institution immediately. Plus, the psychological barrier is incredibly high.
What do you mean by the psychological barrier?
Well, imagine you are a daily wage earner in a rural area, walking into an intimidating, high-security, formal financial institution with armed guards and paperwork you might not be able to read. That is incredibly daunting.
That makes total sense. So how did they actually reach these remote villages without building those branches?
That was the primary friction point for decades. The architectural solution to this was the deployment of agent banking, a model spearheaded by Bangladesh Bank back in 2013.
Agent banking.
Yeah.
Explain how that works on the ground.
Instead of trying to force the rural population to travel to a centralized bank branch in a city, the system pushed the banking interface out to the absolute edges of the network.
By leveraging the existing community, right?
Exactly. The commercial bank identifies a trusted, established local figure, maybe a pharmacy owner or a prominent shopkeeper, and they license them as an agent.
Oh, so they act as a mini bank.
Yes. They equip that local shop with a biometric device that is securely connected to the bank's core network.
So the farmer doesn't have to navigate a complex institutional environment. They just walk into the exact same shop they visit every day to buy groceries.
Right. They hand the shopkeeper physical cash, do a quick fingerprint scan, and that cash is instantly digitized and deposited into their formal central bank regulated account.
That is so smart. And the data shows exactly how effective this localized trust model is. The sources say there are currently 20,557 agent banking outlets.
And here is the key metric. A massive 85.5% of those outlets are located deep in rural areas.
The implication of that geographical distribution is profound, especially when you look at who is actually adopting these tools.
This is where the demographic data gets really inspiring.
Yeah, the source material reveals that 51% of all MFS accounts and 49.5% of all agent banking accounts are held by women.
We are looking at virtually exact gender parity in a demographic that historically faced immense structural exclusion.
The socioeconomic ramifications of that, they cannot be overstated.
Not at all. In heavily patriarchal rural economies, a woman might generate income, right, through agriculture, weaving, small-scale retail, but the physical cash she earned often flowed directly into the hands of a male intermediary.
So she produced the labor, but she didn't actually control the capital.
Exactly, which fundamentally shifts how we should view a mobile wallet.
It's not just a convenient way to pay a utility bill. It is literally a mechanism for circumventing traditional gatekeepers.
Yes. If a woman's earnings are deposited directly into an encrypted application on her personal mobile device, she achieves absolute sovereignty over her own financial output.
And that sovereignty is the prerequisite for capital formation, because once she controls the capital, she can leverage it.
Precisely. Institutions like Grameen Bank and BRC have capitalized on this digital infrastructure to dispense collateral-free microloans, and their client bases are over 90% female.
Wow. Over 90%.
Yeah. Because these women can now receive and repay loans digitally, without needing physical property to offer as collateral, they can scale their microenterprises into viable, independent businesses.
Okay, so we have successfully onboarded millions of marginalized individuals into the formal economy. We've given them digital wallets and sovereignty over their cash. But having an account is just step one, right?
Right. Step two is what technology actually allows you to do with it. We have to move from traditional inclusion to the bleeding edge of fintech.
Because a digital wallet is inherently limited if it can only interact within its own proprietary ecosystem.
Exactly. It's the walled garden problem.
Like, if I have money in my Bcash app, but my supplier only accepts payments via a traditional bank transfer, the friction is still incredibly high. It's like trying to use a completely different language.
That is the exact bottleneck that defines the transition from a basic digital wallet to an advanced digital economy. And the solution is a concept known as interoperability.
Interoperability. Break that down for us.
Think of the early days of the internet. Different localized networks couldn't communicate with each other. It wasn't until the widespread adoption of universal protocols like TCP/IP that the true compounding power of the internet was unlocked.
Okay. So what's the financial equivalent of that protocol for Bangladesh?
It's a government-backed platform called Binimoy.
Binimoy. The sources talk about this. It basically acts as a universal translator across the entire banking sector.
Exactly. It allows instantaneous, frictionless capital transfer from a mobile financial service directly to a traditional commercial bank, or even between competing mobile wallets.
So it effectively merges all these isolated pools of capital into one unified, highly liquid network.
And once you have a fully unified network, you can start building incredibly sophisticated financial products on top of it. Which brings us to AI-driven digital nanoloans.
Okay, this is where the integration of data and finance gets highly disruptive. Because historically, assessing the creditworthiness of a borrower required a massive paper trail.
Oh, massive. Years of tax returns, audited business ledgers, verified property deeds.
But if I'm a street vendor selling tea, I obviously don't have any of this documentation, which means I'm invisible to traditional credit scoring models.
You don't exist to them.
So if we are entirely abandoning the traditional collateral model, how on earth does a bank trust me with a loan? How do they assess the risk instantly?
They replace financial collateral with behavioral data. This is the essence of alternative credit scoring.
Wait, behavioral data, what does that mean?
The AI algorithms deployed by these fintech platforms don't look at bank statements. They analyze the user's continuous digital footprint.
Like what? What are they looking at?
The algorithm looks at telecom data. How consistently does this individual top up their mobile data plan? Are they paying their digitized utility bills on the exact same day every single month? How frequently do they receive small incoming transfers via QR code?
Oh, wow. So the algorithm is mining their daily routine for patterns of reliability?
Exactly. If the vendor consistently recharges their phone balance every Friday, the AI interprets that as evidence of stable, recurring cash flow.
And the machine learning model correlates that micro-behavior with a high likelihood of loan repayment.
Yes, allowing the bank to instantly approve and disperse a small credit line directly to their wallet with zero human intervention.
In milliseconds. That is a phenomenal application of big data. But, we have to look critically at the required infrastructure here.
We do. We need a dose of reality because despite the boom, there are serious hurdles. The sources are careful to point out a major structural vulnerability in this model, often referred to as the digital divide.
Right, because the system assumes ubiquitous, affordable access to the internet.
Which isn't the reality for everyone.
If we are increasingly relying on alternative credit scoring, aren't we risking algorithmic bias? Like, couldn't this just hard code existing poverty into the new system?
That is the precise danger. The data highlights that only 35% of the rural population possesses the requisite digital literacy to navigate these interfaces securely.
Only 35%. That's a huge gap.
Furthermore, the sources indicate that Bangladesh imposes the highest tax burden on mobile data in the entire South Asian region.
The highest tax.
Yeah. So when you combine exorbitant data costs with the upfront capital required to purchase a smartphone in the first place, the digital economy remains prohibitively expensive for the absolute poorest demographics.
You run the risk of creating a totally new tier of financial exclusion. Those who cannot afford the data exhaust needed to train the AI are simply locked out of the credit market altogether.
Exactly. Add to this the persistent cybersecurity threats, phishing, localized fraud, and you have a system that requires immense regulatory oversight to protect its most vulnerable users.
It's a delicate, complex ecosystem at the bottom of the pyramid. But the data proves it is undeniably moving in a positive, innovative direction. Millions are being lifted into the formal economy.
Which is an incredible triumph of microfinance.
It is, which makes the second half of our deep dive so incredibly jarring, because while the bottom of the economic pyramid is experiencing this highly optimized digital renaissance,
the very top of the traditional banking sector is experiencing a catastrophic failure of basic financial gravity.
yeah, Let's look at the overarching issue threatening the whole economy. We have to pivot now from the triumphs of microfinance to the systemic threat of macrofinance.
The single largest existential risk to the Bangladeshi economy is the spiraling crisis of non-performing loans, or NPLs.
NPLs, and these are concentrated heavily within the traditional state-owned commercial banking sector, right?
Heavily concentrated, yeah.
Okay, for anyone new to this, we need to define the NPL crisis in a novice-friendly way. What exactly is a non-performing loan?
It is exactly what it sounds like. A loan is fundamentally a contract. It's an agreement to repay borrowed principal along with a specific yield over time.
Right, the borrower agrees to pay it back with interest.
When the borrower breaches that contract and ceases making any payments, typically for a period exceeding 90 days, the asset ceases to perform.
So the bank is essentially bleeding money. It's no longer generating yield. It is holding a dead asset.
Exactly. And when you look at the aggregate volume of these dead assets, the numbers become genuinely alarming.
Yeah, let me drop the bombshell statistic from the data provided in the sources. By the end of September 2025, the total volume of non-performing loans in the system reached an astonishing 6.44 trillion lataka.
It's hard to even conceptualize a number that large.
It really is.
Yeah.
But the sources provide a percentage that brings the severity into very sharp focus. That 6.44 trillion takaan, that represents 35.7% of all distributed loans.
Let that sink in for a second.
35.7%. If we go back to our hydraulic network metaphor, this means that nearly 36% of the fluid moving through the primary commercial pipes has just turned to concrete.
The capital is completely frozen.
In any standard corporate environment, a 36% failure rate on your core revenue-generating product is an immediate death sentence.
Without a doubt. So the immediate question analytically is how a failure rate of that magnitude is structurally possible. How does that even happen?
Right, and the source material draws a very sharp, crucial distinction here between the types of borrowers driving this crisis. It differentiates between a regular defaulter and what is termed a willful defaulter.
This is a vital distinction because economies have natural cycles. A factory might burn down. A global supply chain shock might bankrupt a legitimate import business.
Right. Those are calculated, acceptable risks that the banking sector anticipates. A regular defaulter is just a tragic reality of risked capitalism.
Exactly. But a willful defaulter is a completely different phenomenon.
Okay, so what defines a willful defaulter?
This classification refers to high net worth individuals, massive corporate syndicates, or politically connected entities that possess the undeniable audited financial capacity to service their debt.
They have the money.
They have the money, but they simply make the active decision not to pay.
The implication is that they are treating these state-owned commercial banks as a limitless source of free capital. How do they legally circumvent the repayment?
They leverage immense legal and procedural arbitrage. They utilize high-powered legal teams to exploit loopholes, file endless injunctions to delay asset seizures, and generally paralyze the debt recovery courts.
But doesn't the central bank try to combat this?
The regulatory framework attempts to, yes. If an entity is identified as having the means but refusing to pay, they are issued a final notice. If they ignore that mandate for 2 months, they get officially blacklisted.
Which theoretically cuts them off from all future credit and imposes severe corporate restrictions.
Theoretically, yes. But the reality of a 6.44 trillion taka deficit suggests those regulations were not historically enforced with any meaningful rigor.
Which brings up an even more pressing mechanical question for me. How did the numbers get this bad without anyone noticing? A 35% failure rate doesn't stay hidden on the balance sheets overnight.
It was systematically camouflaged through an accounting mechanism known as evergreening.
Evergreening. Let's break this down, because if you're looking at a balance sheet, evergreening sounds like a positive, sustainable metric.
It sounds lovely, right? But the reality is that it is pure financial fiction. It is perhaps the most insidious practice in banking governance.
So how does it work?
It is the systemic denial of reality. When a massive, politically influential borrower defaults on a multi-billion taka loan, acknowledging that default requires the commercial bank to immediately write off the loss against their own capital reserves.
And doing that would instantly reveal the bank's insolvency to the market and the regulators.
Exactly. So to avoid this, the bank's board of directors simply issues a new loan to the willful defaulter.
Wait, they give them more money.
Yes, and the defaulter uses the funds from the new loan to pay the overdue interest on the old loan.
Oh my God. On paper, the original loan suddenly looks active, healthy, and green.
Precisely. The regulatory algorithms see an interest payment and classify the asset as performing.
But economically, no new productive capital has been generated at all.
None. The bank has simply increased its exposure to a toxic borrower, compounding the underlying rot while projecting a facade of stability.
It's like paying off a maxed out credit card by opening another credit card. But for billionaires.
Exactly. It's the financial equivalent of putting a Band-Aid on a broken leg and calling the patient cured, or prescribing painkillers to treat internal bleeding.
Now, we get to do a quick rule check here. It's important to note how the source documents frame the root causes of this systemic evergreening and willful default.
Yes, we are impartially reporting the text's claims here without taking a political side.
Right. But the texts explicitly tie this crisis to severe structural governance failures over the past decade. They identify deep-seated political influence in the lending process.
Suggesting that massive credit lines were regularly approved based on political patronage rather than rigorous objective risk assessment?
The sources also point heavily toward the monopolization of corporate governance. They detail scenarios where single families or highly concentrated syndicates gain dominant control over the boards of directors of multiple commercial banks.
Which is a huge conflict of interest. When the same tight-knit group controls the entity dispensing the credit and the corporate entities receiving the credit, all internal checks and balances evaporate.
The vetting process just becomes a rubber stamp.
And the documents even highlight the alleged misuse of corporate social responsibility, or CSR, funds.
Right, suggesting that capital meant for public welfare was redirected to serve political ends, particularly in the lead-up to national elections.
This culture of systemic leniency essentially signaled to the largest borrowers that debt repayment was optional provided you held the right leverage.
So the analytical pivot we have to make here is understanding why the listener should care about this on a macroeconomic scale.
Yeah, because if you are modeling the system, it is easy to view a billionaire defaulting on a state bank as an isolated, victimless accounting error.
Just numbers on a screen, right?
But the physics of the banking system guarantee that the pain of that default is immediately transferred to the lowest rungs of the economic ladder.
Because of the ripple effect.
Yeah.
Let's trace the mechanics of that. When billionaires don't pay back loans, the bank has a liquidity crisis.
Right. The commercial bank has trillions of taka frozen in non-performing assets. The fluid in the pipes has turned to concrete.
But the bank still has liabilities. It still owes that 4% interest yield to the millions of honest, everyday citizens who deposited their life savings.
It still has to keep the lights on and pay its staff.
So if the bank's primary revenue stream, the interest from its massive corporate loans, just evaporates, it faces an immediate existential liquidity crunch. It literally has no cash.
To avoid immediate collapse, the bank must aggressively widen its interest spread to generate emergency capital.
And since they can't extract capital from the willful defaulters, they extract it from the honest participants in the system.
Exactly. When a legitimate mid-sized business owner, perhaps a manufacturer looking to expand their production line, approaches the bank for a loan, the bank is forced to charge them an exorbitant, highly inflated interest rate.
The honest manufacturer is effectively being taxed to subsidize the losses incurred by the corrupt billionaire.
It's devastating. High interest rates choke off legitimate credit creation. The manufacturer abandons the expansion project. The construction jobs to build the new factory are never created.
Furthermore, the manufacturer has to raise the prices of their existing goods to cover the inflated cost of capital, which injects artificial inflation directly into the consumer market.
Everything from food to building materials becomes more expensive for the average citizen. It creates a vicious cycle of stagflation's stagnant economic growth coupled with rising prices.
And perhaps most dangerously, it completely destroys public trust. If the general public, observing all this inflation and corporate impunity, loses faith in the solvency of the commercial banks.
You risk a systemic bank run. If everyone demands their deposits back simultaneously, the illusion of the evergreen balance sheets shatters and the entire hydraulic network collapses.
Which is a terrifying scenario. And it brings us to the final and perhaps most urgent phase of our analysis. The situation sounds dire. So what is the referee, the central bank, actually doing about it?
The central bank has to step onto the field and initiate massive structural intervention. The sources outline a deeply aggressive strategy to stabilize the sector.
They talk about the highly complex processes of mergers and liquidations. Let's get some simple definitions for these terms.
These are basically the tools of financial surgery. When a commercial bank reaches a point where its non-performing loans vastly outweigh its performing assets, the regulator must intervene before the contagion spreads.
So a merger is combining two institutions into one, right?
Yes, it involves taking a profoundly weak, failing institution and forcibly integrating it into a fundamentally healthy, well-capitalized bank.
But wait, the immediate logical pushback to a merger strategy is the risk of contagion. If you tie a sinking ship to a floating ship, don't they both just sink?
That is the exact systemic risk that terrifies the markets, and it's a valid concern. However, the mechanism behind this, dictated by the new bank resolution law, is designed to isolate that toxicity.
How so?
The primary objective of the merger isn't to save the failing bank's executives or shareholders. They are usually wiped out. The objective is to protect the depositor's money.
To ensure the everyday citizens don't lose their life savings.
And exactly. The healthy bank absorbs the retail deposits and the salvageable assets, while the central regulator often helps quarantine the toxic debt.
So they strip out the bad management and inject rigorous corporate governance into whatever is left.
Right. But if an institution is completely hollowed out, if there is simply nothing left to salvage, the regulator deploys the ultimate sanction.
Liquidation.
Liquidation. It is the formalized death of a financial institution.
When a bank is truly dead.
Yes. The bank's charter is revoked.
Yeah.
It ceases all operations. Liquidators are appointed to aggressively sell off every remaining physical and financial asset the bank holds.
From its office buildings down to its few performing loans.
Everything. The capital generated from that fire sale is then distributed hierarchically. They prioritize the repayment of the retail depositors first, while institutional creditors and shareholders absorb the massive losses.
It is a brutal process, but it is necessary to clear the deadwood from the forest. And the source material highlights that this isn't just a matter of executing a few liquidations.
No, it requires a systemic overhaul of the regulatory environment itself.
The texts note that an interim government, led by Nobel laureate Professor Dr. Muhammad Yunus, has formed a highly specialized 6-member reform task force.
Their mandate is to clean up the sector, to redesign the architecture of the central bank to prevent this specific crisis from ever recurring.
And what are their action steps?
The cornerstone of their reform agenda is establishing absolute, uncompromised independence for the central bank.
Because for the hydraulic system to function securely, the entity controlling the pressure valves cannot be subject to the political whims of the entities consuming the fluid.
Exactly. The regulator must have the unilateral authority to penalize willful defaulters and enforce reserve requirements without political interference.
Enforcing zero tolerance for fraud.
Yeah.
And they're backing that independence with an overhaul of the digital accounting standards, right?
Yeah.
The sources specify a transition toward IFRS 9 standards.
Yes. IFRS 9. This is a game changer for monitoring.
If we're trying to understand the mechanics of reform, how does IFRS 9 actually stop the practice of evergreening?
Okay, so historically, banks operated on an incurred loss model. They only recognized a loan as bad when the default actually happened.
Which gave them ample time to evergreen the asset before the auditor arrived.
Right. It's like waiting until the car is totaled to admit you are a bad driver. IFRS 9 shifts the entire system to an expected credit loss model.
Expected loss.
Yeah.
Meaning they anticipate it.
Yes. It requires banks to utilize digital, real-time, forward-looking data to instantly provision for potential losses the moment a loan's risk profile degrades.
Oh, so it completely eliminates the hiding space. If the algorithm detects that the borrower's broader financial indicators are weakening, the bank must immediately lock up capital to cover the anticipated loss.
Transparently reflecting the true health of the balance sheet to the regulators in real time.
So you couple that rigorous digital oversight with a mandate to replace politically appointed board members with fiercely independent professional financial experts, and you begin to rebuild the structural integrity of the sector.
It is a massive, multi-year undertaking. But it is essential to highlight that even amidst this profound crisis management, the system is simultaneously attempting to look forward.
Yeah, to end on a slightly more progressive note, the sources detail a significant push toward a framework known as green banking.
Green banking. It proves that the overarching power of credit creation can actually be weaponized for positive, systemic change.
Because if commercial banks dictate where the capital flows, they ultimately dictate what gets built.
Exactly. Green banking is the conscious integration of environmental sustainability into the absolute core of the credit risk assessment. It is the financial sector recognizing that climate change represents an unquantifiable macroeconomic risk.
So under a green banking mandate, A commercial bank establishes strict exclusionary criteria,
Mhm.
like they just refuse to finance environmentally destructive projects.
Right. If a massive conglomerate requests a multi-billion taka term loan to finance a new high-emission coal power plant or a project that requires deforestation, the bank categorically denies the capital.
They cut off the fluid to the destructive pipes. And conversely, they actively subsidize the transition, right? They actively fund renewable energy.
Yes, the bank offers highly favorable interest spreads to projects focused on renewable infrastructure, solar grids, wind energy installations, highly efficient garment factories.
They leverage that fractional reserve multiplier we talked about earlier to rapidly scale the green economy. It shows a banking system trying to align with the future.
It demonstrates the dual nature of the financial system perfectly. It can be a vector for profound corruption and systemic collapse, but it is simultaneously the only mechanism powerful enough to fund a rapid society-wide transition to sustainable energy.
Wow. We have covered an immense amount of systemic architecture today. Let's synthesize this journey. We started by mapping the fundamental hydraulics of the economy, understanding how the central bank regulates the pressure, while commercial banks utilize the interest spread and credit creation to sustain agriculture and industry.
We analyzed the brilliant execution of the inclusion revolution. We saw the sheer power of banking to do good.
Right, giving a rural female entrepreneur a digital wallet and AI-driven credit, using mobile financial services, agent banking, and interoperable platforms like Binomoy to bypass decades of friction.
But we also dissected the devastating consequences when banking goes wrong. We stared into the 6.44 trillion taka abyss of the non-performing loan crisis.
Trillions of takas locked up in bad debt by willful defaulters. We broke down the insidious accounting fiction of evergreening and the devastating macroeconomic reality of how elite debt inevitably translates into hyperinflation for the working class.
And finally, we explored the aggressive structural interventions, the mergers, the liquidations, the real-time monitoring of IFRS 9, and the mandate of green banking attempting to rebuild the system's integrity.
It has been a massive deep dive. But before we go, there is a final provocative thought I want to leave the listener with and mull over, something that builds on everything we've discussed today.
Yeah, and it goes like this overarching narrative of the relentless digitization of capital. Because the push toward a perfectly frictionless, completely cashless society offers unparalleled inclusion, right? It brings the street vendor into the global economy.
It does. But we have to think about the cost of that transition. As we move toward a totally cashless society, every single transaction you make leaves a digital footprint.
Every utility bill, every data recharge, every micro transfer, it is permanently logged.
And that data can be used to include you in the economy, offering you instant nanoloans.
Hmm.
But it also means your financial life, your economic viability, is entirely in the hands of the very institutions we've spent this time discussing.
The same institutions that have struggled with deep structural governance failures.
Exactly. So in a world where physical cash, which offers total anonymity, is disappearing, you have to ask yourself who genuinely controls your economic agency. In a fully digitized economy, who actually holds the power? The person with the money or the algorithm that scores your financial worth?
It requires a terrifying amount of trust in the integrity of the referee.
It really does. Thank you so much for joining us on this deep dive into the mechanics of our financial reality. We encourage you to keep questioning the systems around you. We will see you next time.